Well, good evening, everyone, and thank you so much for joining tonight to the latest of the APPG on blockchain. This evening, we'll be discussing tokenization and blockchain-based digital assets with some really exciting guests to introduce to you in just a few moments' time. Let me just also intimate the apologies of Lord Waverley from the other chamber, from the House of Lords, who won't be able to join us this evening. But without further ado, I'd like to hand over to Birgitte Andersen, who is the Chief Executive Officer of the All-Party Parliamentary Group. And I know, Birgitte, you're going to have to leave us a wee bit earlier than usual. But we're so grateful that you're able to be with us here today. And I'll just hand over to you at the moment.
Hello, everybody. We're really looking forward for tonight's meeting on tokenization. Clearly, when people think blockchain, at least in the early days, it was all about tokenization and digital assets. And that's something I'm really personally quite interested in as well. We are, of course, very happy we have such a panel tonight. I also want to say that now the APPG blockchain have been running, we are moving towards a few years, and we have now finally managed to develop a proper community platform. And I will just share that in very, very quickly here. And we have developed a community platform where we can have we have our chair, we have our vice chairs, advisory board, parliamentary members, and you can also submit to become a member, and you'll be listed on the and we are also very delighted for our sponsors who've made all this possible. And within this platform here, we can actually all who are and we can discuss on the pavilion wall, see who the members are and follow them. And of course, we can view all the different events which we have on the APPG blockchain coming up for 2021, and the dates and times you can put into your diary. And on the media center, you can see all the videos we have done since beginning 2018, and you can see our photo gallery on the day the APPG blockchain was actually incubated. And we have libraries and galleries. So I'll stop sharing now here, but you know that there is this platform available. Many of them, I know that our advisory panel is already now onboarding to it all day today. And we will email the link on how the community, the outsiders, although you who are sitting, looking at the screen now, how you can actually onboard this community, and we can have a proper interactive platform. And on the pavilion wall in the middle, we can have a discussion forum. And if you're familiar with platforms like LinkedIn or Facebook and other, you will be familiar with participating in this. The only difference here that this is the first open project platform in which we can all co-create and see who its others are. So I'll now hand back to Martin, but I just want to let everybody know this is a quite big step change in the way in which the APPG blockchain, both online as well as physically inside Parliament. And that means that we have the best of two worlds. So moving forward, when we hopefully are back in Parliament as well, we can run a hybrid in the years to come. Thank you very much.
That's great, Birgitte. And yeah, I do hope that everyone takes an advantage of the new platform, the network on the Big Innovation website through the All-Party Parliamentary Group page on the website. And a couple of things that we really need to mention today is also, this will be the first time I think we've heard that blockchain, there's no women in blockchain. And to have the vast majority of the speakers this evening who are women is, I think, is fantastic. And I'm honoured and privileged to be chairing this evening. And hopefully not too distant future, we may have a woman chairing this all-party parliamentary group. And so I could just say to this evening's speakers, we're very grateful for you being here. Before I do hand on, I also want to mention the latest report that has been published by the all-party parliamentary group, Blockchain in the Cities. And you can find that either on the Twitter feed, or you can find it on the website of the Big Innovation Centre as well. It's a really important document about how blockchain technology can revitalise, I suppose, in the age of COVID, our cities. And also, I think personally, from my perspective, it's also about how it enables and can assist in the delivery of public services. So it's a great document, and congratulations to the team who have brought it together. Without further ado, I do want to now press on. We all have limited time. And I want to, first of all, introduce our first guest, Faustine Fleuret. Faustine is the Head of Strategy and Institutional Relations for the Association for the Development of Crypto Assets, and really leading in terms of regulation at the European Union level. And we're really looking for Faustine to bring us up to date and up to speed where the European Union is now in regulation and to learn from that. So Faustine, thank you so much for joining us. And I believe you're in Paris tonight, and we're handing over to you.
Thank you very much, Martin, and thanks once again for this invitation and for the introduction. Maybe for completing what you said, it's just that I came from the traditional financial world before working for the crypto universe, and now for this representative body for crypto asset and blockchain professional in France and Europe. So I worked for the financial regulator, then the financial representative body, and I came to Consensus, that is a blockchain company that you may know, to really explore crypto assets and their opportunities. And that's in this context that I had the chance to work for the European Commission as a European Blockchain Observatory and Forum, where I was responsible for writing some reports, including the digital asset report that was released a few months ago, I think. And at the time that I wrote this report on digital assets, I think the European Commission was just starting to think about how to regulate such crypto assets. So a short while later, they launched a public consultation. I know that you have one in the UK now on digital assets. So the European Commission launched their consultation in winter, and finally on 24 September, the European Commission released their digital financial package, including 2 proposals for regulating crypto assets as a whole, meaning that crypto assets is now a new asset class in the sense of the European Commission. So what are crypto assets? First, they are assets that do not qualify under existing regulation. And for this type of assets, the European Commission is willing to set a bespoke regime for both the issuance and the secondary market for those crypto assets. But you also have crypto assets that qualify as financial instruments. We usually call them security tokens. And the European Commission is having a very innovative way to set a framework for such a security token. And in their proposal for such security token, they want to create what they call a pilot regime. A pilot regime is a transitional regime towards a definitive framework for a security token market. In this pilot regime, actors are allowed to benefit from exemptions to the financial regulations, because as security tokens are financial instruments, they must comply with the financial regulation. So this is a very innovative way to address crypto asset market by setting this experimentation that is supposed to last at least 5 years, maybe more. So this is a very good starting point for the regulation of crypto assets in Europe, to give a legal clarity, legal certainty to actors who could not benefit from that before. There was nothing about new crypto assets. So that's a very positive point. However, we have already identified some challenges that maybe should be addressed in the coming negotiations about those framework. First, we can see that there are many breaches for how I will say incumbent actors like banks, investment firms to access the crypto market. It's really easy for them because they have exemptions, they benefit from some equivalence with their services, so they can access the crypto markets. And maybe we can perceive some unequal opportunities for newcomers, crypto newcomers, to access such markets. Maybe in those regulation, there is some lack of proportionality on some measures, including thresholds to fall in the scope of the EU rules, or some rules like prudential requirements, which can be really burdensome for new actors. And they even must financially participate to this supervision. So that's already also something quite new. And also in the European Commission's text, we have identified some rules that would not be applicable by decentralized use cases. And this could put a brake for the development of really innovative projects like decentralized finance, DeFi. I guess that you have heard about it before this. So this is the very beginning of the building of the Euro framework for crypto assets, and I will be happy to give more details if you want. We organized a webinar last week on this with the association, so I would be happy to give more details about this. That was for the framework that is being built in Europe, but maybe you know France already has its own regulatory framework for actors in non-financial crypto assets, really, like what wants the European Commission do a bespoke regime for such crypto assets. And what we could see with this regulatory regime that was established in France is that it gave a great momentum to the growth of the French crypto ecosystem. So today we can say that we have many strengths. We have an already well-established and ambitious French crypto industry that is structured around the association I work for, and we can promote a very close dialogue with the public sector. This regulatory framework in France, even if it's not perfect at all, has attracted the interest of non-French players. So that gave a new impetus to the development of this ecosystem. And we can also see that this regulatory framework provided with a growing democratization of crypto assets. They are now seen as a credible diversification asset, and more and more retail people are getting interested in them, wants to integrate such assets in their portfolio. So it really gives a great dynamic for the crypto asset industry. That's why we hope that it will be the same with the European ecosystem as a whole. But even if we have this regulatory framework in France, of course, it's a good first step. That's what I said about the European proposals toward the long-term deep rooting of the crypto industry, but it can't resolve all barriers to the development of the crypto asset ecosystem. For example, in France, we still suffer from a lack of competitiveness and attractiveness that must be resolved, of course, by the regulation, but not only. For example, finding fundings are, it's very hard. It's a hard battle for actors in both from private sources like private equity, but also from public sources. And that's something really aside from the regulation that must be resolved. We have a very tense situation with the long-lasting difficult relation with between banks and the crypto asset ecosystem. These difficulties takes the form both of the systematic refusals to open an account to these new entrants. We realized a survey, and it's about 68% of participants which experimented such a refusal. They are also refused to be provided with a credit or with the payment services that they provide. And we can also see many obstacles placed in the way of customers wishing to use crypto blockchain services. So this is also a barrier that is quite detrimental to the developing of the crypto asset ecosystem. Also, you have many marketing promotion channels that are close to crypto asset players, like the ads services of the GAFA. It's very difficult to benefit from such services when you are a crypto blockchain actor. Of course, taxation is must be better explored regarding crypto assets. And what is very hard to change is a very bad image that certain authorities and institutions have regarding the crypto markets because of some fallacious preconceived ideas that they have. So even if regulation is a very important in UK, in the EU, in France to promote the growth of the crypto asset ecosystem, we see many other things to do. For example, authorities, the public sector must better understand crypto assets and their functioning. First, to understand what are their regulatory deadlocks and why there are some adjustments needed. What is the true level of risks that crypto assets bear? And what are the opportunities for public authorities and users, both in terms of investor protection and efficiency of markets? We think that the public sector should better pay attention to some anti-competitive behaviors from credit institutions, from, for example, the GAFA regarding the ads services. For the UK, I think something very important is to ensure a level playing field with the EU regulation, and at least to not regulate harsher than what the European Union will do. And finally, the most important is that everyone should promote the crypto assets use cases that prove bringing significant market opportunities to create a more peaceful environment for crypto actors. And I think that's something we do promote. The public sector should really listen to the crypto asset ecosystem. So not to prevent innovation from developing in Europe, in UK, means more than regulation. There are many efforts to do, but it's really important because we can see the risk that innovation runs away to develop in other economic area. So thank you very much for your listening.
Thank you so much, Faustine. And I think you raised some very important issues, especially for parliamentarians who might be listening in relation to level playing fields with the European Union. And hopefully, when we do have an agreement, I won't mention the B word. Man, may I also apologize for a small visitor I had on my screen just a moment ago. It's actually a small whippet sitting beside me, and she might be appearing throughout this evening's webinar. She'll be another guest. Moving on swiftly, I want to bring in Sheila Warren, and Sheila is the head of blockchain data and digital assets in terms of the World Economic Forum, and really now looking at a global perspective from the World Economic Forum. And Sheila, we're absolutely delighted you've been able to join us. And we're going to maybe just pass on the floor to you. I know I believe you're in San Francisco, so it's I am. It's morning time for you, and the sun has duly set here in Scotland, but it certainly hasn't for you. So we'll hand over to you, Sheila.
Thank you so much, and thanks for having me. I thought what would be most useful to begin would be to just lay out some of the issues that we take as axiomatic in this space. So when the forum is thinking about digital assets and tokenization, where are we beginning in terms of our assumption set? And I'll lay some of that out before I move into some recommendations. So first of all, back to basics. What exactly is tokenization? It's a digitized way of holding an asset wrapped in a programmable layer. So asset tokenization basically is the process of converting ownership rights in an asset into a digital token held on a blockchain or on a DLT. And we think that this tokenization and these new models are going to enable new markets, as Faustine said, by decreasing barriers to entry and friction to the information exchange and trade. So we've already seen some of this happening with stablecoin and other kinds of new innovations that have happened in the space. But I think what's really interesting is the idea that we can take a process that was very onerous and analog and turn it digital. So it becomes much faster to take an asset and break it down into pieces and share the ownership of that, like the slices of ownership of that. You can do this with future earnings. You can create interesting futures contracts on these things. And of course, the blockchain gives you an immutable record-keeping system. So the slice of ownership becomes like a contract. And with smart contracts technology, you can program in the rules around that with the underlying asset and store all of that on a blockchain. Now, this is very analogous to securitization processes that have been around for a very long time. And in fact, some of the risks are similar. That let's start by talking about what a digital asset or tokenization really enables. And again, these are things that we just take as truths. So one I think that's really interesting and where we're seeing a lot of consternation from the banking industry is that one of the reasons that correspondent banking remains so powerful is because it's really how global liquidity, this is how global liquidity functions. So we enable the movement of value across continents based on banking relationships right now. I can send money across a border because my bank has a relationship with a bank or an FI in another country, whether directly or indirectly. And what's coordinated are the ledgers of those correspondent banks. But if the bank stops having that relationship, poof, that liquidity is gone. And with it goes my opportunity to move that money across the border efficiently. This all goes away with a digital asset. Because the digital asset is the book entry and the unit of value, we can move liquidity around the world immediately and directly. We don't need correspondent banks, in theory, to keep ledgers and balances around the globe. And of course, these are balances that can be retracted if a bank decides that holding a balance in a jurisdiction is risky for whatever reason. And certainly de-risking has been a very big issue in the wake of financial crises and other things that are happening. So we're seeing this ability to move quickly. Yield farming is an example of what we're seeing. And of course, it's not only faster to do this, but it's cheaper. And so what I think is important to note here is that there is this resistance from certain actors and the incumbents in the sector because of what the potential is here and what it represents. So that's sort of something we take as we're seeing that resistance. It's not surprising. And one of the reasons we aren't seeing even more takeoff in this area is because some of the incumbents do have that vested interest in the current systems remaining the same. Okay, let's shift briefly into discussions of what are the benefits here. Well, the ability to represent ownership of real assets on something like a blockchain can change asset management. We think the potential for financial inclusion is one of the most important aspects of digital assets. So right now, as is obvious, high value investments are just not available to the vast majority of the global population. And we think that the expansion of capital markets here could be quite profound. It's an evolution really in capital mobility and the ability to raise capital, whether that's by entrepreneurs or even in a micro lending kind of context. And the reasons for that, of course, are in theory, again, there are no territorial barriers. So an investor from anywhere in the world could invest in things halfway around the world. So I, sitting in San Francisco, could invest in real estate in Greece if I wanted to. And you can use the blockchain to really secure that ownership. Similarly, there is a potential for reduction of intermediaries or completely removing them altogether, which is what this can really do in its realized form. Third-party brokers slow the process down. It's more efficient, it's more expensive, it's more confusing. And you don't have to worry about the risk of adding error because of the way you can actually use the tech to code in some of the rules. There could potentially be lower investment risk. You could imagine creating more global, more diverse portfolios because of potential for incremental ownership of a lot of different assets. And of course, as I already mentioned, the improved liquidity of tangible assets is something that is really critical because you have this potential for fractional ownership. So overall, in the kind of best case scenario, the globalization of capital that could result from tokenization models could increase the demand and ease market entry barriers, which could lead to diversification, growth, and as I noted, what we think is most important, more inclusion in the market. But the question really is, how can tokenization make illiquid assets in this way more accessible, but without creating new financial risks, whether those are individual risks or systemic risks? And there are really good reasons why it's not easy to do some of this in the analog world. And some of those risks definitely carry over into the digital world. We want market integrity. We want consumer protection. There are real risks around asymmetric information or fraud. Certainly with e-commerce marketplaces, we did not imagine, 15 years ago that there would be a way for a platform to help reduce information asymmetry. And it remains to be seen if innovators here can and are willing to do the same. Certainly, this is a self-regulating technology, and the software can help with things like automated payment of taxes, for example. But there's a lot that the tech can't do. And certainly we would not advise letting the industry self-regulate. I think we've seen how that's gone in other contexts. And so that is not something that I think any of us here are interested in porting over into this new space. Now, it won't surprise anyone familiar with the forum that to realize the advantages here, we think that we need a very global, multi-stakeholder approach to this. We think we need consultation with the private sector. We need to think about civil society organization engagement. And of course, we think we need multiple jurisdictions collaborating and working together. Regulations here are very siloed, very country specific. So while in theory, there is this global access, that is really limited by the lack of global regulatory alignment. There are issues with security infrastructure and safety regulations. There are issues around property rights enforcement. Taxation itself is very complicated, as we all know. It's not made easier by this new model. It's if anything, it amplifies some of the complexity there. There's a couple of things that we think are really important to think about. One is authentication of the underlying asset. So certainly with things like mortgage-backed securities, we saw a lot of the slicing and dicing happening. Again, that's not really new. But what was created were these pools that were highly, highly risky that were then shipped off to unsuspecting customers, and we all know what happened. So making sure that there is authentication that the underlying asset purported to be represented is really linked to the token, because the value of the token is obviously undermined if that linkage is not real. How do you do that? Can there be regulation that makes that more possible? That's something that we think is really important. Another issue is governance. If you have a building, to use my example of the building in Greece, and you divide that up across 100 people, well, how do you ensure there's responsibility for maintaining the building? And you're not just kind of selling a crumbling, highly depreciated asset that doesn't actually have anyone maintaining it. Who bears those costs of maintenance, rent collection, insurance, whatever it might be? Someone still has to want to manage the underlying asset. So are there ways that regulation can ensure that there is some check in place to make that happening? And then how do you even spur and create, I think Faustine mentioned this as well, this market around certain things? So one of the common examples used in this space is the farmer who can sell the rights to his future crop yield, and that incentivizes him to kind of, incentivize the government to help him create more yield and this kind of thing. But how do you even create a market like that? How do you give that access directly to an individual shareholder farmer? It's just not very realistic in the current scheme. And lastly, one of the things I think we have to really focus on is the need for clarity. So right now there's a lot of muddying. I haven't even gotten into security tokens and utility tokens and all this kind of thing. But we do need clarity in the methods of creating and exchanging tokens, but not just domestically. We need that to be global or at least international, because a lot of this activity is going to happen across a border. So with that, I will pause my remarks and wait for questions.
That's great. Thank you very much. I think one of the issues you talked about, inclusion, for me, it also requires a recognition that there is exclusion. And I think that, as a politician, I think that's extremely important. And the issue you mentioned about self-regulation not working, and coming as a Scot, coming from the land of Adam Smith, even Adam Smith recognized the requirement for regulation, given the fact he ended up as a tax collector in our capital in Edinburgh. And I totally understand that self-regulation does not promote inclusion from my perspective, and of course it doesn't enhance economic security. With that though, I do want to now press on, and we're going to go to Neha Narula, who is, I believe, in Cambridge, Massachusetts, in the east coast of the US, and probably just starting, I should say good afternoon, Neha, and we're going to hand over to you as Director of the Digital Currency Initiative to give the view from academia. And to take us into that kind of academic perspective. So we'll hand over to you.
Thank you, Martin. And I want to say good evening or good afternoon to everyone who's joining us. Thank you very much for having me here to participate. I appreciate the opportunity. So as was just said, I'm the director of the Digital Currency Initiative at MIT. We're a research group located within the MIT Media Lab, and our mission is to do the research necessary to make it easy to move value as it is to move information. And we are very much focused on doing neutral, rigorous research while serving the public good. So those are our goals. And we're a group of computer scientists and open source software developers who've been working on cryptocurrency and blockchain technology since, for some of us, since 2010. We also, I'll just add, are very honored, in addition to working on cryptocurrency and blockchain technology, we're engaged in a sponsored research agreement with the Federal Reserve Bank of Boston in order to design, build, and test a robust hypothetical digital currency platform that can meet the needs of a national retail payment system. So very technology focused, still very much the research stages, but looking at building out the technology in order to potentially build a central bank digital currency. So I think you've heard a lot about the opportunities here, and the opportunities are many. We have the opportunity to rethink the way money rails work. We have the opportunity to upgrade a lot of very slow, very inefficient, sometimes physical systems. I'm reminded of some of the software running inside some of the most important computers inside of banks. That software is written in a language that was developed in the 1950s. So there's many technological advances that we can take advantage of here, and there's many ways to think about redesigning some of our software systems, and the potential is quite great. But I actually want to talk about the flip side of that, which is how to be responsible and think about some of the technology risks that could be introduced by this new technology. So I think we really have to be cognizant of not only the risks in the technology, but the incentives of the participants who are involved and who might be speaking about the technology. It's not clear that it's best to follow the path of large internet platforms here. If we think about the web and the internet, what started as a very open competitive landscape evolved into monolithic companies, which emerged with control over many aspects of our digital lives, including civic discourse. This was all quite unexpected and was not necessarily predicted. So these companies have emerged as de facto gatekeepers over what news we see, what programs we can run on our mobile devices. And we're scrambling now to try to backfill, to try to figure out how to regulate these companies that have become quite powerful, and how we want to think about privacy and ownership of our data. So it's very clear to me that as we engage in this next era for digital money and new financial systems, we need to be very thoughtful and focus on open, accessible platforms which promote competition and choice. So though we might be tempted to rely entirely on the exciting developments in the private sector for innovation, the ethos of move fast and break things is not going to work for the global financial system. Central banks, which are responsible for safeguarding financial stability, are rightly entering the fray to more deeply understand the risks and the promise of the technology. And in addition to this important research and development, we need to deeply interrogate the new technologies and examine their underlying incentive structures. So a lot of people here will propose that blockchain technology is best suited to build upon to create economic innovation. So you will hear a lot about blockchain systems and systems that utilize blockchain-like data structures. Now, unfortunately, I don't think it's possible to simply hide all of these systems behind the label of blockchain technology. We have to actually get into the details. We have to actually understand what types of features these systems support and what are their risks. And the two I want to talk about today are security and incentives. So I want to stress to you that whenever you hear the phrase blockchain, you should remember to ask which blockchain. This is very important. They all have different designs, features, security properties, and incentive structures. So saying something uses blockchain is like saying, I'm going to travel between Cambridge and London using transportation. What does that mean? That could be a boat, a 737, a canoe. There's many different ways to transport yourself that has many different properties and will result in very different speeds and times and safety even. And just as that, there's many different ways to build upon, to build these new economic structures with tokenization and securitization, and some of which might not require a blockchain and might actually, in fact, be built using centralized systems with a new interface. We're currently in the research phase of this, and so we really need to make sure that we are including neutral, unbiased, rigorous technology researchers in this conversation. Now, the point of the technology is to a lot of this new technology is to remove trusted third parties, remove the need for intermediaries by using cryptography and systems, new distributed systems. Unfortunately, these systems are very challenging to get right. Sometimes they can have very subtle bugs. And a lot of projects in this space are quite immature and have not yet had the time and attention put upon their software in order to vet their systems. So you might hear a lot of projects say that we're open source. And so this means that we're secure because anyone can see what we're doing. But unfortunately, in practice, given the hundreds, if not thousands of different projects out there, it's not often the case that every open source project actually gets eyes and attention on them. For example, in 2017, my team found that one cryptocurrency project called IOTA was not using best practice cryptography and had actually written their own cryptographic hash function. This is considered a no-no in when building secure cryptographic systems. So this project was totally open source, but it turned out that no one was actually looking at the code. No one had actually taken a look at their hash function to see what it was doing. And this was a very big security hole. It meant that people could potentially lose access to their funds. And again, like I said, a lot of these projects don't necessarily have the system set up in place to even talk to people who are finding these types of security holes. And the incentives are not quite aligned either. The technologists sometimes aren't necessarily incentivized to share the potential problems with their systems with regulators because the technology is so tightly connected to financial incentives in the form of tokens. So in 2017, many projects did these things called ICOs, and many are now being held to account for doing unregistered securities offerings, rightly so. Even those that did not directly sell tokens to the retail public often engaged in practices like minting very large numbers of tokens and holding them inside of a nonprofit foundation or a company. For example, Stellar and Ripple are two projects that did this. Because the foundation and company, which houses most of the developers on the project, hold so many tokens, they're incentivized to make the price of that token go up. That is often ends up sneaking into the work that they are doing. This is in contrast to other cryptocurrencies or projects that might not have done an initial token sale or a minting. For example, Bitcoin did not do an initial token sale or minting. And these are very different than securitized tokens or projects where the token actually is supposed to represent some kind of asset that exists in the real world. So we have many different types of financial incentives and different types of tokens happening here. And as Sheila pointed out, an important risk when we're thinking about tokens that are representing assets in the real world is who is monitoring that linkage and who is actually making sure that that asset is accessible to whoever holds the token, and keeping tabs on the counterparty risk of the potential entities that are holding these assets. So in summary, I just want to make the point that the technology here, unfortunately, cannot be abstracted away. It is critically important to the risks, to the failure modes of this different software, to the risk to consumers, to the risk to counterparties. And we have to sort of really interrogate the technologists who are building these systems and really get them to explain to us where there might be potential security holes, where things might have been glossed over or done sort of more quickly, where they have not figured out the answers yet. Around scalability, around privacy, and around security. The most popular blockchains today are completely public. All transactions are visible to everyone in the world. So this isn't something that's really going to work for inclusion and for our future financial system. So there's still quite a bit of work to be done. I think this technology has tremendous promise. It's very exciting, but it's really important to do due diligence on the incentives of the people and projects we engage with, and to get to the details of what's going on. So thank you very much. I really look forward to continuing this discussion.
That's great, Neha. And I thought it was really interesting when you talked about not just about the private sector in terms of innovation. I mean, I think as the chair of the all-party group on Estonia, that I look at a nation of 1.5 million that's utilized blockchain-like technology to be probably one of the most innovative digitized nations on earth. So you raise some really challenging issues for us, I think, all to consider. We're going to move on quickly. Teana is joining us as well now from London, who is the director of Looking Glass Labs, and I'm told very recently was the UK director of Binance, one of the world's largest crypto exchange in the world. And we're really looking at that business element of crypto assets and tokenization through blockchain. And without further ado, Teana, we're over to you.
Well, thank you very much, Martin, and thank you to members of the Blockchain APPG for inviting me to join you today. Today I'm the Managing Director of Looking Glass Labs, which is a consultancy specializing in strategy and policy for digital assets in the blockchain sector. And as you've said, Martin, yes, until recently, I was the UK Director for Binance, where I led the UK market strategy as well as government and regulatory affairs in Europe. Prior to Binance, I was the Executive Director of Global Digital Finance, which is an industry association working with policymakers and regulators and the industry to facilitate a better shared understanding of the risks and opportunities of digital assets. I was asked to speak today about the latest developments within the digital asset industry and how the market has evolved over the last several months. So in short, I believe that the promises of tokenization are starting to come to fruition, and the growth and maturation of the digital asset market continues, which is good. This growth has been aided by discussions like these, which facilitate more informed policy decisions and greater regulatory clarity, which we're still lacking on the whole, as Sheila mentioned, globally. In just over a decade, blockchain and cryptocurrency have gained mainstream attention and have encouraged governments to rethink money. Economic indicators demonstrate shifts in trends after they occur, not necessarily during the inflection point, which is where I believe we are today. Early cryptocurrencies led to the emergence of tokens with a variety of mechanics and unique utilities of economic and technical functions. For example, we've talked about some of these different types of tokens that enable access to a service or a payment, or that account for an asset. And increasingly, tokens can simultaneously now perform several functions. We all were aware of 2017 and the ICO boom, but token sales continue to be a major funding mechanism for innovative startups, enabling rapid evolution within blockchain and open decentralized technology. I think this is because many entrepreneurs have found that token offerings perhaps better enable a community-driven network effect business growth mechanism, which is more aligned to their business models than traditional venture capital funding. Tokenization on the whole enables cost reduction and new economic incentives, which would have otherwise not been viable, and generate innovative value creation. For example, Filecoin, which maybe not the best example today, but are creating systems for decentralized cloud data storage, where users can pay to store their own files or be paid for offering unused storage space back into the network. One evolving area is DeFi, or decentralized finance, which is an open finance movement built upon public programmable blockchains like Ethereum. Sheila mentioned earlier correspondent banking, liquidity, and yield farming. DeFi uses smart contracts, automated enforceable agreements that don't require intermediaries like banks or lawyers, but rely on blockchain technology instead. DeFi's proponents endeavor to disrupt mainstream financial services such as lending, asset trading, payment services, and insurance, to name just a few, via operating without a central authority. DeFi has experienced explosive growth in 2020. The total US dollar value currently locked in decentralized finance protocols today exceeds $11 billion, according to the on-chain data resource DeFi Pulse. Crypto.com and Boston Consulting Group recently published a report summarizing that regulation and governance have given centralized finance an enormous proportion of the value generation from financial services. Whilst DeFi may be perceived as a threat to centralized finance, this report proposed a roadmap for financial leaders to build a new generation of politically and technologically resilient financial solutions that may be more relevant for today's digital economy. By removing some of these intermediaries and automating functions, DeFi can lower lower costs, provide higher degrees of security and privacy, and increase accessibility. The ability to borrow funds, take out loans, deposit funds into a savings account without asking for anyone's permission is really gaining traction. For example, the DeFi service Compound boomed when it launched its Comp token in June of this year. Users who provided liquidity to Compound services earned a Comp token as a reward, thereby earning returns on their assets. Many DeFi platforms have since adopted similar incentive mechanisms, which have caused the value of the assets in DeFi to surge. Due to its level of accessibility, DeFi may enable greater availability of financial services such as credit and investment opportunities to people whose access has been previously limited. So this is where the inclusion piece comes in. However, DeFi is still a concept that's in its infancy, and it's not without its risks. So today, the over-collateralization required for borrowers to access DeFi loans makes it a bit impractical for the mainstream unless they are already crypto owners. And many DeFi protocols require a level of knowledge to use, without which users can inadvertently be exposed to additional risks. So what are those risks? They're related to slow blockchain throughput, high transaction fees, limited liquidity, which cannot supply the higher liquidity demands of larger market participants, security and smart contract risk related to vulnerabilities that might put assets at risk of theft, or bugs in the code that may allow for price manipulation. And regulatory risk also exists. DeFi operates within areas that traditionally have had significant oversight from governments and regulators who are charged with protecting consumers from high-risk products and scams. DeFi protocols have been designed to be permissionless, which means it allows anyone, anywhere to access them without regulatory compliance. And whilst this democratizes DeFi for the greater good, regulators have concerns that DeFi could be exploited by nefarious actors. However, DeFi could be regulated in a partially permission model using decentralized KYC and AML methods to authenticate identity and potentially block users that are deemed to be unsuitable. Crypto usage and crypto-based services are also beginning to mainstream. A number of digital asset exchanges have begun integrating everyday fiat payment services like PayPal. Numerous merchants like AT&T started accepting crypto payments for their services, and crypto-funded credit cards enabling crypto users to transact with crypto through traditional payment rails have become very popular. And numerous members of the US Congress are accepting 2020 campaign donations in crypto. It has also become clear that digital assets can do much more than replace fiat currencies. From art to real estate across traditional financial markets, the tokenization of real-world assets can, could enable a sea change in the democratization of wealth creation. HSBC recently published a report entitled The 10x Potential of Tokenization, stating that the total market size for global fixed income and equity was worth approximately $178 trillion in 2019. But currently, 43.9% of global wealth is held by only 0.9% of the world's population. So that's more than half of the global population holding a mere 1.8% of the world's wealth. HSBC surmised that 84% of the world's population would need to save for more than 2 years to afford a share in each of the top 5 market cap companies. And so that group would really benefit from affordable access to a wider range of investable assets. Tokens are divisible, so you can create fractional investment opportunities. And imagine if anyone could purchase 1/10 or 1/100th of a share of Apple or Amazon. Fractionalization would make it more affordable for a larger part of the population to participate in equity markets. And with the use of blockchain technology and greater regulatory enablement, this is not impossible to achieve. In conclusion, I think it's important to note that most of this innovation is occurring in spite of government support and regulatory clarity, despite many of the digital asset industry advocating for regulation. AMLD5 and the revised FATF 40 recommendations have begun to address money laundering and terrorist financing concerns. And these global and regional directives have aided in reducing some of the cross-jurisdictional regulatory arbitrage. As Faustine mentioned earlier, the European Commission recently published a new draft bespoke regulatory regime for the entirety of Europe. Once implemented, it will provide a level, passportable regulatory playing field in Europe, but also a level commercial playing field for industry participants, and the regulatory clarity and institutional access to enable innovators to invest and develop their future roadmaps and build profitable businesses in Europe with confidence. The UK has taken a slightly different approach, focusing on market activities individually versus addressing the industry as a whole. Following a series of consultations, the UK doesn't appear to be much further forward in establishing a clear regulatory framework for crypto asset innovation in the UK. The UK has a rich history of supporting innovation in fintech. However, digital asset innovation has not received the same level of proactive consideration. With, I'm going to say the B word, Martin, with Brexit looming and with other competitive global financial centers such as Hong Kong, Singapore, and Europe establishing clear rules of the road for digital asset integration into traditional financial service markets, the UK risks being left behind. By building the infrastructure to support new marketplaces, we can begin to lay the groundwork for the opportunities emerging from tokenization to bloom and maintain the UK's position as a global financial services center. And thanks very much.
Teana, I think that is a really good way to end that section. And I do again have to say, if you hear anything strange going on in the background from my end, it's because there's two dogs sitting right next to me. And I think what was very important, one of the issues you talked about, is also recognition by us as legislators about our role about understanding both the sector, what actually does tokenization actually mean, and its impact on democratization. I often use the word polyarchy because our types of democracies are also very different types of blockchain. And we actually require certain pillars in terms of our democracies, and one of those needs to be openness, transparency, but also governance of finance. Without further ado, and I know that we are a wee bit behind time, I am now going to head over to Roham, who is, I believe, in Vancouver, in what we call Western Scotland for some of us, plenty of Scots out in Vancouver. And we just want to hand over to you as the Chief Executive of Kitty Business, which has been through a really exciting couple of months and couple of years, I think, would have to say, and shocked quite a few folk about your business approach and what you've been able to achieve, and to bring that nuance to us this evening. And we're really grateful for you to take the time out. So over to you in Vancouver.
I appreciate that. Thank you very much for having me. Definitely going to try and present a slightly different picture than or an additional picture to what's been said tonight. But as a quick introduction, my name is Roham Gharegozlou, founder and CEO of Dapper Labs, which is the company behind CryptoKitties. That's one of the most successful non-currency, non-monetary applications of blockchain, and I want to talk a lot about that. We also open sourced our own blockchain technology based on a lot of our learnings with CryptoKitties. That's called the Flow blockchain earlier this year. And just a couple of weeks ago, we launched the first application on top of the Flow blockchain, which is NBA Top Shot, which you can go and play around with what feels like a sort of what a new kind of blockchain feels like. Before CryptoKitties, my background was in developer platforms. I was founder and CEO of Axiom Zen, a venture studio that successfully built and spun out multiple products into independent businesses. First was Fuel, a gaming platform. We grew to over 200 million users before it was acquired. Axiom Zen also built Routific, which is a route optimization platform that's saved, I believe, over 11,000 tons of greenhouse gas emissions in 2019 alone, which is great to see. And most recently, before CryptoKitties, we built ZenHub, which is a team collaboration solution that's built specifically for developers. And there we have customers like Microsoft, IBM, NASA JPL, and many others. But the key thing I want to focus on is I was asked to answer the question, sort of, what is tokenization? And I want to answer it, but I want to step back a little bit, because this reminds me, this sort of feels to me like a hearing on the internet and the web, but all we've talked about is websites and email, and it really goes way bigger than that. I think blockchain is way bigger than digital money. It's much bigger than financial systems. And with all due respect, I hard disagree with Neha. I think we need a lot more private sector innovation, especially in the West, places like the US, UK, and Canada, before governments step in. And in fact, that's a big part of what I want to talk about today. I think projects like IOTA and others are some of the worst offenders in crypto. It's very unfair to paint the entire industry with that same brush. So I want to sort of dive into what we see as tokenization, what we see as blockchain. And before getting into the token, I want to talk about the blockchain that runs the token. And in a lot of ways, the blockchain is effectively a new kind of computer that can run new kinds of software applications. As you've already heard, different kinds of blockchains can run different kinds of software applications. The first generation, things like Bitcoin, can really only do one thing, right? They can host a digital currency and they can manage the ledger of who owns what, and so kind of host a economic system outside of anybody's control. That's great. But in the case of Ethereum and newer generation blockchains, things we call smart contract networks or general purpose blockchains, these are computers on which anyone can write any kind of application. That's what we call smart contracts. But the reality is smart contracts are not contracts, and they're not really smart. They're just software programs that can run autonomously and control tokens as part of their operation. So if smart contracts are analogous to smart contracts on blockchains are analogous to software on your local computer, on your personal computer at home, then the token is essentially the files that the application needs in order to do its job. So there are different kinds of tokens. You sort of heard payment tokens, utility tokens, that sort of thing. But we broadly see them as two categories: fungible and non-fungible, and I'll touch on that. But before we get into sort of specifics of tokens, I want to touch on the benefits of tokenization, the benefits of putting things on blockchains. You've probably heard people talk about transparency, auditability, security, chain of custody, provenance, all these things, and those are accurate. But the biggest step function change that happens, the thing that enables all of these sort of effects, is that when you put a piece of software on chain, and when you put an asset on chain in the form of a token, that piece of software, that asset, essentially functions as a digital public good. A piece of digital commons, something that once it's deployed, nobody can change, anybody can build on, anybody can use just by showing up with the token. You heard the term permissionless, and it was defined as you can't regulate it. That is not what permissionless means. Permissionless means nobody can stop you from using it. And in a world where the vast majority of our lives are digital, and those digital worlds are controlled by massive software companies that are not being transparent with us, I think digital commons are more important than ever. And the nature of permissionlessness is the fact that companies like us, the sort of new generation of internet companies, can't stop a user from accessing their data. We can't stop a developer from building an alternative version of our product on top of our network and users leaving our product to go use it through the new product. And what this means is choice, right? It gives consumer choice back to individuals. It lets developers and startups and innovators build on top of data without fear of being locked out. And it lets software be a kind of public good that compounds over time. And of course, it is global and international, but it can solve specific problems that small groups of people can get around and coordinate. So blockchains are public computers. Tokens are the fuel that makes them work. And I want to dive a little bit deeper into that. The second question we were asked to answer is, how can tokenization become a reality? And for that, I want to tell our story, because for us with CryptoKitties, we realized this is the path the industry was going down. We started in crypto back in 2014. We built CryptoKitties back in 2017. And since then, we've been developing a new generation of products. And our goal since the very beginning has been to show people that blockchain and cryptocurrency goes way beyond currency and way beyond money. And the reason we created CryptoKitties and the so-called non-fungible token standard, my co-founders and I coined this term non-fungible token because almost every crypto asset before CryptoKitties was a fungible asset. It was either a currency or a commodity. And in a sense, fungible means that it doesn't matter which specific item you own, it only matters how many. Bitcoin and others are same thing, US dollar, the UK pound, etc. But most things in life are non-fungible, right? The homes we own, the art we own, our progress in a video game, our data, our friends, all of those things are non-fungible. And we wanted a cryptographic primitive to represent those kinds of assets. So non-fungible tokens are now a standard part of the Ethereum network. They're part of every blockchain developed since. And they're a much more, if sort of the fungible token is the fuel, the non-fungible token is kind of the building block with which you can build a more interesting world. So we're already seeing it apply to digital art, CryptoKitties themselves. It's a video game, but the art pieces, the kitties themselves have been taken out of the video game and displayed on in museums all around the world. They've been auctioned by companies like Christie's, where a single cat was bought for over $140,000. So it shows the power of digital assets that are bigger than its creators, and that actually will live on no matter what happens to the person that originally made them. And we're already seeing non-fungible tokens being applied to all kinds of other things. For example, individually unique insurance policies, where a specific policy can be tokenized and then sold on decentralized markets with perfect transparency and no information asymmetry, because everything is open for everybody else to see on this sort of public computer. So I think this concept of a public computer is a very important thought for policymakers like yourselves, because it's a demonstration of a new relationship that people can have with the products that they use every day, and that developers can have with the business opportunities that are out there. And fundamentally, it means more competition, more choice, and a better outcome for everybody. This is, Balaji here is one of our investors and advisors. This is a tweet he sent that I really liked in terms of framing this shift here. I wanted to share it with you all. And his point is basically that on-chain is an evolution of online, and tokens are just digital assets that have been put on-chain. Now, if you remember that discussion about digital commons and the idea that anything on-chain can be used or built on by anybody else, I want to use that kind of thought to answer the third question that was asked, which is, what will financial institutions need to consider to be part of the token economy? And the reality is they will need to focus on adding value, not being middlemen, not being intermediaries. And this is the sort of last thought I'll leave you with, is we talk a lot about this, blockchain will cut out middlemen. And it's a little bit scary to most people because the internet cut out a lot of middlemen, and it actually created some massive, massive companies that have more power than any of those middlemen ever did on society and on daily discourse. And they have more money and more defensibility in a business sense than any of those previous middlemen ever did. But the reality is that the internet hurt physical middlemen. But all of those, the giants it created, Facebook, Airbnb, Uber, etc., those companies are digital middlemen. They actually wouldn't have any value. They wouldn't exist if it were not for people like you and me adding value to them, adding our information to them, bringing our friends to them, being drivers and riders. And they end up putting these walls around us, right, around their users, preventing other developers from accessing them, and in some cases taxing the customer and providing a worse user experience. So crypto and blockchain is the first time you can have open networks that a customer can use a specific product and then leave that product, but not leave the underlying network, because the underlying network is open, it's public, anybody can tap into it. That's the core innovation here. And the reality is that entrepreneurs like me, people who want to follow the law, who have more to lose than to win in many cases, are being hamstrung by the unclear regulation, while teams like IOTA and other folks that were sort of alluded to here, they can plow forward because they don't care. At the end of the day, it's unclear, and so they'll probably get a wrist slap. And so that's my final ask to you: support and clarity for the industry to innovate. And what that means is not a very detailed policy map of, hey, this is allowed, that's not allowed, because the design space is too unexplored. There's way too much that's still left to discover to right now for policymakers to come and put walls around what entrepreneurs can and cannot do. What we actually need is a safe harbor, a period for any legitimate project to try anything, to explore different use cases, to make clear to their customers, look, we're in a beta stage, this is an experimental product, but we're going to go ahead and allow innovation to happen because the reality is, you heard central bank digital currencies. Well, this is a step function change for the world on the scale of the internet and the World Wide Web. The difference is that this time China is way ahead of the West in terms of their understanding of the technology, in terms of their buy-in at the policymaker level. And what they're doing is building a closed version of everything that we just talked about, building a highly controlled version that is transparent, but to them and under control of them. And I think for industry, people like us, we are being hamstrung by this discussion around what is allowed and what is not allowed. So that's my ask: safe harbor and the ability to innovate. Thank you very much for listening to me on behalf of every entrepreneur in this space. I think most people are in this space because they want to make the internet a more open place. All of us grew up in the 90s and early 2000s and are caught by surprise by how much things have changed. There are, as with any technology shift, ways that the technology can be misused. And I think that at the end of the day, the truth will win out, and we'll end up with a more open world. Thank you very much for listening. And I'm here to answer any questions.
Roham, thanks so much. And you certainly put out a lot of challenges, I'll give you that. It must be the fresh air in Vancouver, I've got to admit. It certainly raised some issues for me, and I think maybe also some of the advisory panel members. And I noticed you talked about the opportunities to innovate and to do anything. I suppose I'm sure you would appreciate, as a legislator, that kind of sends the alarm bells off in my head when I reflect on places like the People's Republic of China, because I suppose as a legislator, when I look at the People's Republic of China, their ability to innovate and to, what I would say, press ahead regardless, is that they don't exactly reflect the standards in terms of governance and critically in terms of democratic participation. They're two, I often think it's like trying to reflect on, like apples and pears. They're both fruit, but they're certainly very different, and they both have very different tastes. Neha, I think Rohan came in there with some very robust challenges. I don't know if you maybe want to come back in before I go to questions, because I also know maybe some members of the advisory panel might want to come in as well.
Sure. Yeah. Thank you. And I just want to say, I think that there are a lot of really exciting projects out there that are bringing value to the world and are delighting consumers. And CryptoKitties is definitely one of them. I was very honored to have a CryptoKitty made in my image. That was a very exciting moment for me, and I've seen people use them and get very excited about them. So not at all to say that all projects are evil or anything like that. It's just that you do have to look at the underlying technology of each project itself. I think there are a lot of people out there who will say they're designing some great new NFT sort of thing, and it turns out actually they're just trying to sell these things ahead of time, and then they might jump ship. And so it's just very challenging sometimes to tell the difference between the entrepreneurs who are going at it with morals and ethics, and those who are just trying to take advantage of people. So my only point is that it's important to ask the questions. That's it. But and to be clear, I do believe as well that a large amount of the inefficiencies in our current financial system have to do with the fact that the large incumbents have built up these regulatory moats, which have stifled competition. And so competition is extremely, extremely important here. And we need to give innovators the ability to innovate. However, they need to be able to do that without taking advantage of people. That's the key challenge. That's a really hard balance to set, I think.
Yeah, indeed. And I'm just wondering, do any of the members of the advisory panel, they want to come in?
I got a question for Faustine, which is a European-centric question, so apologies for that. But it builds a little bit on the conversation that you're having in chat. And I wonder if you have any thoughts about whether the crypto asset regulation in Europe will tell us anything about how to develop the capital markets union that has taken some time to get going. And so behind the question is, a broader question around, if this is successful, do you think it could even feed into or potentially supersede what has been quite slow to get moving in Capital Markets Union?
Thank you for your question. I'm not an expert of the Capital Markets Union. So I hope that I will provide good insights anyway. The European proposals for regulation that covers all crypto assets, meaning not only financial markets that could be tokenized on blockchain, is a good step to provide clarity for actors, meaning the development of the crypto asset ecosystem as a new asset class, but also the optimization of financial markets as we know them today. But in the current state of the proposals of the European Commission, my main concern is about the access to crypto newcomers, and I mean the really innovative entrepreneurs that have the best knowledge and expertise of blockchain and crypto assets, of the functioning of crypto assets. And if you have a look on how it is drafted, it really favors incumbent actors. We can understand why, of course, they already led some regulatory efforts to be regulated. So yet they can have some bridges to access crypto markets. But how do we want to build them, and including security token markets, so optimized financial markets? My main concern is about the typology of actors which would be able to participate in giving more efficiency to financial markets. That's why it's a good step forward, but there are many efforts to do to help new crypto newcomers to be able to participate with other actors.
Thank you, Faustine. Is that okay, Charles?
It is, yeah. I think it's a good answer to a question that was on quite a tangent. So well handled.
Well, I'm going to go maybe to the floor, actually, in terms from Hamed Zigari, who's asking, how do you bridge the gap between the Wild West public blockchain projects, his words, not mine, which have some exciting innovation in pockets, and tokenization that can be adopted in early life? Any goers on that?
Yeah, I assume it's real life rather than early life, but I think look, like if you look at the early history of the internet, the earlier you go, I mean, actually the internet didn't have this sort of massive rocket fuel of tokenization, but scams and Wild West actors are a normal part of every new technology shift, especially when there's big dollar signs. I think the way we deal with it is by adding more and more expanding the ability for more and more legitimate actors to enter the space. Many people, even investors, are afraid to invest in crypto. Banks are afraid to work with crypto companies. Universities might be afraid, other than sort of forward-thinking folks like MIT, et cetera, may not be willing to look into cryptocurrency because of the atmospherics, et cetera. So I would say, instead of focusing on, policymakers, we should go after specific scams, et cetera. But I think the best thing to do is shine more light on the projects that are not scams, try to educate the public on what the technology is actually used for, what's an unrealistic promise versus not otherwise. The reality is that there are a lot of unfortunate projects out there, but the reality is everybody knows the resources are already there. You can, for example, with IOTA and others, you can do the research and figure out that, look, people have known that thanks to the work that MIT and others have done, that these folks should not be trusted with at the same scale as others. And as the industry matures more and more, these it'll sort of wash out. That's my personal opinion. We have been in this. We've been trying to build stuff in crypto for a long time. We've been hamstrung and sort of had companies fly past us, promising the world, raising more money, and disappointing folks in the end. But at the end of the day, it's a natural process of creative destruction that will lead to a better outcome if it's left to work itself through. And people getting burned is part of the maturation process of the industry. Lots of people individuals are sort of taking very high risk, and at the end of the day, the technology is transparent. Anybody can look at the code themselves and figure out what seems like something they should or should not get involved in. So that's my sentiment. It isn't. It's not a heavy-handed approach. It's a let the industry mature, shine the light in darkest corners, and sort of the end result will be worth the pain in the interim.
I think I'd like to come back in on that, but I'm going to go as a legislator. But I think what we'll do is we'll go to Petko, who's one of our advisory board members, because I know he does have a question. Petko, over to you.
Thank you. My next question is to Roham again, in regards to the central bank digital currency and other tokenization of digital assets. In example, for the digital pound, you mentioned something like it's going to be a breakthrough, like similar to the internet. Like, would you please elaborate a little bit on this one? What did you meant there?
Well, I'll borrow something Neha said. The internet made it really easy for anyone around the world to create information, to distribute information, and to consume information. And I think the blockchain does something like that for value is one way to put it. Trust is another way to put it. And fundamentally, it's an equivalent step function shift. So Mark Andreessen, for example, has been on the record talking about the biggest problem in the original sin of the internet was that they didn't build payments into some of the core protocols of the web. And because payments weren't built in, that led to a whole flourishing of basically the economic engine of the internet is actually advertising. And so to me, the reason I say crypto is as big of a shift as the internet is because it does two things. It adds a business model for digital creators without needing middlemen. So an artist, any individual can create a piece of software, create a digital asset, sell it directly to their fans. No intermediaries required. In fact, the intermediaries work for the creator and the consumer. They create interfaces that the consumer can choose to interact with the creation, the token, the asset, etc. So that's one big step function shift. The other big step function shift is if the internet, if you think about it, software before the internet was run on your computer and sort of used on your local device, right? It was personal computing. Before that, there were sort of these giant servers that served software directly to sort of dummy stations. What the internet did was it let software run on big servers hosted by giant private companies, and then get streamed into have the data get streamed into local clients, the sort of web applications that you use every day. And crypto sort of flips that on its head. It lets software run without a server, and it lets people be able to access it from any device. And this is why I'm saying it's bigger than currency. So it does add a payment method. It adds a business model for digital creators, but most impactfully, it lets software run without servers. And what that means is anybody can build on top of that software. Anybody can remix that software, etc.
Thank you, Roham. My question was central bank digital currency. Would you trust them the same way you trust crypto?
I think central bank digital currencies will be a fantastic on-ramp into crypto. Right now, you heard a lot about the accessibility issues. The people that have crypto early on, they're sort of crypto wealthy, and they're the first sort of entries into every application. What central bank digital currencies, absolutely, I would trust them. I mean, none of this is about mistrusting the sort of the base currency of the government. I mean, depending on the streams of the industry, some folks are more about that than others. So us, in terms of building applications, we're excited for the central bank digital currencies because they're just another way for people to come into these digital platforms, as long as those currencies can be used in decentralized applications, right? But if you put those walls around and you say, hey, you can only use this in this bubble and use it to buy Starbucks, that's not an interesting kind of, I mean, it's fine, it's great, it's better for policymakers, you have transparency, you can tax people automatically, et cetera, but it's not what's going to lead to that sort of outburst of innovation, because people aren't going to want to build in walled gardens, especially one controlled by the government. I mean, if you think about it, I think entrepreneurs would rather build in a walled garden controlled by Facebook than by their local governments.
Well, I don't know about that, but that's coming as a politician. But anyway, from a non-North American perspective, that does raise, of course, questions around how trustworthy your governments are, whether they be elected on a regular basis and removed freely, or unelected and dictatorial. But that's, I think, a completely different APPG, I'm afraid. I know that Naveen wants to come in if he's there as a member of the advisory board.
Thank you. Sorry. Thank you, Martin. Unfortunately, I don't have video because I'm stuck at home on my phone. I just wanted to raise a couple of issues. So the problem with crypto in the last few years, that it is a maturing technology, and it has been a bit of a Wild West issue, and I can sense a bit of a friction from some of the evidence givers today, and I think this is not necessarily the right environment to challenge those assumptions, and I think they do make some good points. And all I ask is that at some point following this meeting, that we could have a chat with them and discuss these issues, and then feed back to the committee afterwards.
Sounds like a very reasonable proposition to me, sir. So thank you very much for that. I do notice, before we maybe bring to a conclusion, because we're behind time already, and some of you may still have a day ahead of you. I can tell you here in Scotland, it's nearly, time is now marching on. There is a question to Neha from a member of the public. You rightly point out that existing technology dates from the 1950s. Now, whilst I grew up in the 1970s, I don't go that far back. And you understand this includes blockchain technology itself. Therefore, none of this is new. In your view, what has led to the sudden, and for them, the extraordinary take-up of blockchain in recent years?
Yeah, so when I mentioned the point about the 1950s, I was talking about mainframe computers inside of banks that use COBOL, for example, and Fortran, and they're running out of programmers who can actually speak these languages because they've all sort of moved on or passed away. Blockchain technology, there's a really interesting, excellent article by some academics talking about Bitcoin's academic pedigree. And in that article, they take a look at all the different pieces of technology that went into Bitcoin, but it applies to a lot of blockchain technology. And some of them did have existed for decades. For example, digital signatures and hash functions. These cryptographic primitives have been around since the 70s and 80s. Zero knowledge proofs are also quite old, actually. But really, no one tied it all together in this way. And I think that there is something to be said about that as a very important innovation, and really bringing into it the economics, the incentives, not just the cryptography, not just the distributed systems, but that third piece, the incentives, really connecting it all together, and being able to have an open system that anyone can access that is still secure and is secured by the incentives of the underlying tokens and technology and whatnot. That was, I think, really a breakthrough. That was really something that we had never seen before Bitcoin. And then since then, so many different teams have been building on it and just really pushing the boundaries in terms of what kinds of things we can do inside of that structure and framework. So what has led to the sudden extraordinary take up of blockchain technology? Well, I mean, I think a bunch of pieces came together at the right time. And as Roham said, there's a business model. There's money to be made, and that is an incredibly motivating thing, and is getting a lot of people out there trying to experiment and build on top of it.
That's great. Thank you so much indeed. And I think it's been a very informative debate and discussion, because I think it challenges many of our conceptions of tokenization and also the blockchain-based digital assets and their engagement, not just in, some would say, the digital world, but also what others would call the real world, and the kind of the mesh and merging of both in the society in which we are now living in. And I have to say, as someone who grew up before the internet, it really does sometimes still feel like the wild, wild west. And there certainly is also an opportunity for legislators across the world from many different types of backgrounds to have a requirement to understand the technology, its implications, and understand if they are creating legislation, that it's done in a way in which they have a deep understanding of what the technology actually means. I kind of thank Faustine, Sheila, Neha, Teana, and Roham for joining us both this morning, this afternoon, this evening, to the advisory board, to all the Big Innovation Centre who have facilitated this event. And for those of you whose questions haven't been answered, we'll try and get those answers to you. And of course, you'll be able to find this event on the website, because it, of course, has been recorded. Again, my thanks to all of you for participating, and hopefully we'll see you soon. Stay safe. We're living in rather strange times, and I hope we can all meet again sometime in the physical world in a not too distant future. So from me in Scotland to the rest of you across the globe, thanks very much for joining us. We'll hope to see you at our next event. So good night, everybody.
Thank you.
Thank you very much.